obscene cost of losses, and we had mentioned that the losses hurt way more than the gains will help. And I was into that year one where we had 50% loss. Of course, our principal had been cut in half. And this is where the losses hurt more than the gains will help, because in year two, we've got to get 100% return to get back to where we started, because we're working with a smaller amount of principal. And so in year three, if we had a bad year again, and then in year four, we had another fantastic year, at the end of that 4-year run, our ending balance is right back where we started at $100,000. Now, the frustrating thing about it is the fund could report an average return of 25%. And who wouldn't want to invest in a fund that's done 25% over the last 4 years? But the crazy thing is, you could have been in that fund and your balance wouldn't have moved forward one bit. And it feels misleading. It's misleading for the people who own the funds. It's misleading for the guys that sold the funds. It's very, very frustrating. In fact, as I've talked to hundreds and hundreds of people, many of our baby boom generation have kind of given up on retiring. They've kind of given up on that whole dream of, man, if I just work hard for my work life, I can accumulate maybe $1 million, and then I can stop working and just live off the interest, and that's the retirement dream. And if I could get 8% on my $1 million, that would pay $80,000 a year in interest, and I could have a decent quality of life and live the life I want to have. Well, it's wrong in a couple of different ways. A, that $1 million hasn't accumulated because we've lost so much principal. In fact, the stock market's taken back 35% of account values twice over the last 5 years. And in fact, I saw something just about a week ago that the average American net worth has decreased by 40%. It used to be 113,000 or so, currently at about 70,000. And so we don't have that big nest egg to generate, this interest. And even if I did have $1 million today, where could I go get 7 or 8% return and live off the interest? The safe money is sitting in a money market account that pays 1%, or maybe it's in a CD at the bank paying 1 or 1.5%. Even $1 million at 1.5%, that's only $1,500 a year. There's no way I can live on that. So we've got people who've just kind of given up on retirement. And they're like, I guess I'll just work till the day I die. Well, let's talk just a little bit about the stock market's returns. This is an interesting chart. Goes back to 1900, the opening day of the stock market in 1900. It wrote down where the Dow Jones Industrial Average was the first day of the decade, and then marked where it was the last day of the decade. So it's a 10-year return. Now, if we look back over the last 50 years, which to me is the relevant time frame, maybe we go back to 1960. The 1960s, that 10-year period, 1.65 return. The 1970s, 0.37% return. The 80s and the 90s was when the market did really well. In the 80s, we're at 12.8%. In the 90s, 15.1%. And this is a time when we had these tech stocks, we had the dot-com boom, we had this tech stock bubble. And this is a time when the baby boomers were just plowing their money into the market because it was so great. So they were putting every dime they could into the stock market. And when people are buying, that makes the prices go up. Well, what I'm trying to say is I don't see that kind of a market ever again, because right now we've got baby boomers retiring at about 10,000 per day. And when people start to retire, they start moving their money away from the market. And it's not just the boomers that are moving money away from the market. It's people that are tired of losing that 35% of the balance. And so when money's coming out of the market, it really has no choice but to go down because people are selling, and prices drop when that happens. Well, we look back over the decade of 2000 to 2010, we lost 0.5%. What's it going to be the next decade? I don't know, but I don't think it's going to be the 12.8, the 15.3 as I look back over the last 50 years, which is frustrating. When I used to sell things into the market, I was always talking about a 12% return. Well, we just don't really see it anymore. Well, people who've wanted to make some changes and get out of the market have moved their money over to these cash accounts I was talking about, the money market, the CD at the bank, because they've had enough of the Wall Street risk, the Wall Street gamble. They're just trying to keep that principal intact so they have something. And they realize that there's something called inflation, but they feel like The risk of inflation is better than losing my shirt. Well, what are the effects of inflation? What is inflation? It's too many dollars chasing the same amount of stuff. And Washington continues to make some great commitments. I guess debatable. I don't want to get political. They're making commitments that will require the presses to just keep running. And what happens again when there's more dollars chasing the same amount of stuff? The prices go up. If there was a 6% inflation, which it's been over probably the last 30 years, I think it's higher. But if that's the case, I've got a teenage daughter. If she wants a pair of those outrageous $200 jeans, if I wait for 2 years to buy those jeans, they're going to be $225 because, again, at 6% inflation, there's more dollars chasing those jeans. But really, what is the effects of inflation on our dollar? Back in 1971, President Nixon took us off what's called the gold standard, which was when there was $1 of gold for every $1 of greenback currency floating around in the economy. And when they came off of this dollar, off the gold standard, the purchasing power of the dollar immediately started to drop. As you look at the graph there, as you look at the torn dollar bill, look at that first real big drop that goes from 1971 to about 1981. So over that first decade, in 1981, what that chart says is it takes about a dollar would buy about 42 cents worth of stuff in 1971 money. And so what that means is I'd have to give $1 to buy what I would get for 41 cents in 1971. So over that first decade, we lost so much purchasing power. Now, it's interesting, as you look at the red graph going up, that's measuring the amount of dollars running around in the economy in circulation, because we're just printing more and more and more. And you can see that inverse relationship, whereas we've got more money in the currency, the money itself, each dollar is buying less stuff. In fact, it's showing 2009, I can get for $1 what cost 20 cents back in 1971. So that's what's happening with inflation. As we continue to print, that purchasing power is going to continue to drop. The CPI, which is what the Department of Labor uses to determine what our inflation is, the two most common measurements don't include things like food and energy because that's just too volatile. Cost of oil affects cost of food because most places in the country we've got to truck our food in. And of course, when there's costs more to gas the trucks to get it there, well, they just have to add that onto the cost of the food. Well, what's important really is what's your personal inflation rate? Because I buy gas, and all I know is it's what, $3.79 or something at the pump right now, and it seems like about 3 years ago it was under $2. And that tells me that the things I buy, the inflation's gone up way more than 6% if the cost of my gas has doubled in 2 years. Well, let's look at just how we find out how money grows. It's interesting that Albert Einstein said the greatest miracle of the 20th century was this thing called compounding interest. But really, how does it work? And I love that there's a very simple rule to see how money works, and it's amazing. It's remarkably close to if I punch this out on a financial calculator because I've tested it. But what the rule of 72 says is you take any interest rate that you're considering to learn how it grows, and you divide it into 72. The answer is the number of years it takes for a sum of money to double. I'm going to show an illustration. So let's assume that we had an investment that would pay 6%. And I think you'd raise your hand and say you'd take a 6% investment today. But 6% divided into 72, the answer is 12 years. So it's going to take 12 years for my sum of money to double. And I'm just going to use $10,000 as my example. If you need to add a 0 or 2, that's fine, or subtract a 0, no worries. But let's just look at how it works. So if I'm at 6% maybe at the bank, because there was a time when the bank did pay 6, as that money grows, I can look back, and at year 12, my money would have doubled one time. So I've got $20,000. And then if I let it grow another 24 years, I'd pick up one more double, or my 20 becomes 40. Now, the great thing about the rule of 72 is it's telling us how the money doubles. And so if I could double my interest rate, most people would intuitively say, yeah, it'll double the amount of money you have. And I'd say that's not always the case. It depends on how long you leave your money growing. But 12 into 72, the answer is 6. So my money's going to double twice as often. So my same $10,000, I squeeze in a double at year 6. What that means is at year 12, there's my double of my money at that point in time. But once again, one more double in between at year 18. So now my 40 becomes 80,000. And then at year 24, $160,000 instead of $40,000. And so to me, if I'm over 24 years and I double that rate of return, that doubles and doubles. It's a double double. So I've got double the amount of money. Let's just look, for instance, at 18% because the banks get 18%. They have us bring in our money on a CD and they only have to pay us 1.5% to leave it sitting there. And then they turn and loan it out to someone maybe for a jet ski loan at 12%. Or maybe lend it back to the same person on their Visa card at 18%. Let's see what the banks are doing, because these guys know what's going on. They realize the power of the compounding interest. The same $10,000, but at year 4, I've got a double at 20. And then at year 8, I've got another double at 40. And I'm at year 12, suddenly I'm at $80,000. Continue to let it grow at year 16, it hits 160. And at year 20, I'm at 320. And then at year 24, I've got $640,000 over that same period of time. And so the key here, what I'm trying to say is we want to gather a little bit more return if we can do it safely and try and squeeze in at least one more double over our compounding period of time. If we have one more double, well, obviously we double the amount of money we have. If we can squeeze in 2 more doubles, that's that quadruple of our money. It's a big deal. Well, a lot of the people that we talk about, and we're very passionate about this, have their money locked up and they've kind of given up on it. They're frustrated because the only money they have is in their IRA or their 401k because they couldn't get to it because it had a penalty attached if they touched it. So they've got some money in the IRA. Maybe they've gotten out of the market, moved away from the gamble of Wall Street, and just put it in those money market or CDs where they're getting 1 or 1.5%. Man, they're like, it's dead to me, Gary. I can't touch it. It's only earning 1%. What's the point? I'm getting nowhere. Well, we want to help people jailbreak that money and be able to take advantage of some better opportunities to have a safer, higher return. Well, these guys are frustrated because there's opportunities that they're missing. They've got friends getting some great returns in some alternative kind of assets. Opportunities that they can't fund, like maybe a hard money loan. Someone wants to fix up a foreclosure they bought, and they just want some money to make it happen and get it back on the market in 120 days. And there's good returns in that kind of a thing. Or buy the foreclosure themselves and fix it up and resell it. Or invest in a great business. Maybe they have a nephew that has, he's a computer genius. He's got the greatest next great thing, but they can't invest in it because their money's stuck in a money market account. And maybe they wanted to go out and just buy a sandwich franchise. There's so many things that people could do with their money if they just understood. Well, does the media see this kind of thing? And I say it will. Here's the Wall Street Journal, March 2nd, 2012. IRAs get sexier. This article is all about Mitt Romney and the $100 million that he has in alternative assets in his self-directed IRA, which is what we're talking about. Mitt's got $100 million, and I don't think a penny of it is in Wall Street. But here's a quote. Although IRAs have been allowed to hold a variety of assets since Congress first authorized them in 1974, investors have opted for conventional stocks and bonds during the bull market of the 80s and the 90s, and we saw that in the charts. There were 2 decades where it was great. I don't think there's going to be another 2 decades like that. But what it's trying to say is there's places where we can put our money and get better returns. Just Fidelity and Charles Schwab don't want us to know these secrets because they earn fee income. They earn all kinds of income keeping our money, and we need to break it out and go do something better. Well, more information from that Wall Street Journal article. Alternative assets, which is what we're talking about, make up just 2 to 5% of the $4.6 trillion held in IRAs overall. That's a pretty small slice of the IRA pie is in alternative assets. In fact, how much is $4.6 trillion? It's the value of the largest 25 U.S. companies combined, Apple plus ExxonMobil, plus Microsoft and IBM, all the way down to a small company like Amazon. Including Pepsi and Verizon and JP Morgan Chase. That is a lot of money. In fact, I'm told there's more money sitting in cash waiting than there is in the actual market itself as far as these IRAs are concerned. So there's a lot of money, and I'm going to show you that people want to put it somewhere better. Here's some more from the media. Financialplanning.com, they also have a magazine. They quoted a survey that we're going to look at. Investors are interested in putting a portion of their IRAs towards that alternative assets again, but lack the know-how and often the advisors to do so. Here's more about it. The research found that more than 3 out of 4 American families with retirement accounts want to invest in those alternative assets, but many do not know how to achieve that goal. So 3 out of 4 of that huge pie want to do something different, and we're here to show them how to do it. Here's some more details on that survey that they're talking about. They called 1,000 people. They said, hey, do you know what an IRA is? 658 knew. So then they said yes. They said, how interested would you be in using funds in a retirement account like an IRA to build wealth by investing in alternative assets? 29% very interested, 48% somewhat interested. In just the name alternative assets, they're so desperate they want to go do something else. 23% weren't interested, and I think they were just asleep or not listening. More than half were interested in real estate and precious metals. And that's what we're talking about. That's the beginning, 2 of our core 4 asset classes, real estate and precious metals. This is February 2012, Kiyosaki Research. In that same survey, 365 financial advisors were surveyed. This is naturally where you'd think to go to get access to alternative assets. And in fact, 83% of the financial advisors had been asked about investing in alternative assets by their clients. Sadly, only 10% of those guys had clients currently investing in alternative assets. And the reason is financial advisors can't recommend it. A, because they don't make any money when money goes away from these stocks and mutual funds they control. And B, their rules about securities license keeps them from doing these things. So again, lots of people want it. There's no one to hand it out. Well, we want to show people how to jailbreak their IRA or 401k and get off of the Wall Street casino. Let's get the money out. Convert your account status to allow for access to opportunities in the alternative asset market. This is the story that we're telling. There's ways to do this. It's been legal since 1974, and we already went over that based on that Wall Street Journal article. People at this point want to know, what is an alternative asset and why is it better than what I've got? Well, I'll tell you what it is. It's an asset that gives you control of what happens in your account. Don't let someone else do it, because I promise you, no one cares more about your money than you. These are assets that create cash flow, spendable wealth. You see, it used to be when you owned stock and you were wealthy back in the day, you'd own stocks that paid out a dividend. And once a quarter, you'd get a big check from the companies that you owned stock in. Well, guess what? Hardly anyone pays dividends anymore. So we've got to create an investment that creates a dividend so people can actually retire. Because if your stock or your mutual fund doesn't pay a dividend, well, guess what? The only way to get at your money is to sell it. And that doesn't make sense. We'd rather have people have the cash flow. Also, you want assets that are tangible goods. These are real things. You can drive by and look at it. You can own a deed to a property instead of owning some stock shares in some mutual fund. I mean, and where the values could blow up on an afternoon of bad trading triggered by some cataclysmic event that happens in Europe. You know, the Greek economy crashes. And we don't want to be anywhere near that kind of thing. We want tangible goods that are real, that we own, that we can hold. We also need assets that protect against inflation, because I'm telling you what, inflation is looming. As we continue to print money, that power of our money, as they're printing more, is just going to continue to get watered down, and we've got to protect against it. And so alternative assets over time have been the assets that have offset and paced against the inflation. Well, back when I was a kid, I was so intrigued with the story of Jack and the Beanstalk and that mythical golden goose, because, man, the next day that goose is going to lay another golden egg. And you could take that egg and buy whatever you want with it. And so we're explaining to our clients that they need to buy some golden geese. And so they can continue to have those golden eggs show up in their mailbox every single month and not wipe out the feast. And so as we look at, according to Robert Kiyosaki, who wrote the book Rich Dad, Poor Dad, the only way something you own is an asset technically is if it creates a cash flow. Yeah, we own our home, we think of it as an asset, but technically to Kiyosaki, it's not an asset because it doesn't create cash flow. But guess what? A rental property that creates a monthly rent to your mailbox, that's an asset. Well, we want to have these assets that, again, next month, and another amazing golden egg. Well, we read all about it in the press that people are rushing to hard assets, real things that people own. We call our core four hard assets. The residential real estate that we can own, precious metals, very popular according to the survey. Trust deeds and mortgages, these are private loans that are secured on something substantial and tangible. Again, puts money in our mailbox every single month. And pension factoring, we'll talk about that. Again, can show up every single month, every quarter, every year, depending on the pension itself. We're going to talk about each of these four asset classes. Now, as I've been in the financial industry for about 19 years now, 14 of that in finance, I've seen people buying real estate. And the people who own real estate are the wealthy. But what I haven't liked is the fact that they've had to be a part-time job kind of a guy, where they have to go buy the property, then they fix it up, then they have to go find the tenant, and then they have to manage it and go around and unclog the toilet when there's a problem. Well, what we've got is some of our preferred vendors provide a package form of real estate, which means they go out and they buy the right kind of properties at auction in the right kind of markets across the country. These are places where we can get a great rate of return and where there's jobs for people that want to rent our properties. We want to make sure that if something devastates the auto industry, that there's some other industry to employ our people, and that's why Detroit went on its tail. Same thing happened in Las Vegas. If there's no one gambling and no one vacationing, there's no other jobs in Las Vegas. So we have great markets. They go out and buy the properties in the markets they choose. They buy them at auction. They rehab them like that picture in the top right. And then they put great tenants in place that are paying rent. And so these are 1 to 2 year leases. And then a great property manager to take care of the heavy lifting. So they take care of it. And so real estate in a package like this starts to look more like an investment rather than a part-time job. Here's a couple of examples of properties that our preferred vendors have supplied in the past. Here's a condo complex in Fort Myers, Florida. Beautiful place. In fact, 2 Major League Baseball teams go there for their spring training. It's an A+ kind of location. It's a condo. It's 2 stories. There's 1 bedroom, 1 bath, all the way up to 3 bedrooms and 2 baths. Here's what the pool looks like. Here's a picture of what it looks like on the inside. In the kitchen and in the bedroom. These are nice units. Bali High purchase price for this kind of a place, $60,000. These people provide for us some what's called non-recourse financing, where we could take our IRA dollars and secure this property all by ourselves for $29,750. The other part of it is a loan. But the great thing is, based on the rents, as we take out the cost of the insurance, the homeowners association fees, and the property management, we're still getting a cash-on-cash return on our $29,000 of 14%. Nice rates of return. It makes us start to feel kind of like the bank with our credit cards. We're getting those kind of great returns, and we're secured on a beautiful piece of property. Well, here's another one of our great real estate vendors. Likes the properties in Memphis, Tennessee. Here's a great residential piece of property. The purchase price was $70,000. They provided financing of $33,000, and so our client was able to come in and secure this property for $37,000. The loan for the financing piece here was 6.99%. The adjusted net income after paying the taxes, the insurance, and the property manager fee, we're still getting $6,500 every year on our $37,000 put down. That's an adjusted cash-on-cash return of 17.6%. Now, that's again kind of that 18% thing we looked at on the rule of 72. And it's secured by a beautiful piece of property in a nice middle-class neighborhood in Memphis, Tennessee that has some great potential for appreciation. And that's not even in the calculation. This is cash on cash if the property never increases in value. And it's funny, back when we were doing these rental property home loans back in the day, these guys would just buy the properties hoping to make money on the appreciation. Well, even if it doesn't appreciate, we're still getting 17.5%. We really love the real estate asset class. Well, why do we like precious metals? And we think that a percentage of our clients' money should be allocated to precious metals, gold and silver. Why? Because this is a storehouse of value over time. While economies continue to print money, gold and silver hold its value. Here's a great example that goes back 1,000 years. Back 2,000 years. And here's the example. 1 ounce of gold has always bought a fine suit of clothing. Going back 2,000 years, back in ancient Rome, 1 ounce of gold bought a beautiful tunic and a great pair of sandals. Dropping back 100 years ago here in the U.S., 1 ounce of gold would buy a great suit, a shirt, a tie, a hat, and some shoes. Now today, 2011, 1 ounce of gold today, probably, I didn't check the price, but it's probably about $1,600, $1,650 for an ounce of gold. Would buy today a beautiful suit, a great shirt, a tie, and a hat, and a great pair of shoes. In fact, I could get you a custom suit, a custom shirt, a great tie, and a pair of Allen Edmonds dresses are beautiful. But it's amazing to me that the value has been held in gold. Okay, the dollar amounts, prices, of course, go way up. Let's look at what silver does. It's also a storehouse of value. Now, it used to be that in the United States, they would put silver in our coins. Well, they stopped doing that a few years ago. Back in 1960, though, the amount of silver in a quarter was equal to 5.6 grams. Now, let's look. It's also interesting that back in 1960, a quarter would buy a gallon of gas. Now, of course, a quarter today doesn't buy anything. In fact, I don't even think 1/4 buys a payphone call. But it's interesting that if we had 5.6 grams of silver today, it would buy a gallon of gas. And so, again, our precious metals is holding the value of, against, for our commodities. And that's why we want to hold some stuff in silver and gold. Storehouse of value, again, here's a chart that shows the cost of gold stayed even with a gallon of crude oil. That's the red is the cost of gold against oil. If we look at blue, that's the British pound against oil. The green is the US dollar against oil. Went way up against the value of oil, but yet gold holds its value. Over time, it's not meant to be an investment, though I guess if you'd have bought gold 10 years ago, you'd be happy about where the values are today. But we're not telling people to go out and speculate using gold and silver. We're saying have a portion of your money in gold and silver to hold the value. And we can buy gold in as small of quantities as about the size of your pinky fingernail, down to a gram. And so if things went crazy in the economy, you can actually use it as an exchange. Well, as small as 1 gram. Let's look at our third, great core pillar asset class, which is trust deeds or non-recourse lending. Now, these are some houses that clients have lent their money as people have come in to purchase them. Viewpoint Lane in Ellenwood, Georgia, that purchase price was about, I think it was about $70,000. So someone came in and said, all right, I'll loan 35%, or I'll loan $35,000 against the purchase price. They generally get about a 6% rate of return on this kind of a loan. It's secured on a single-family home or a duplex like what we've got pictured. This is an individual note where you are lending to the buyer on the home. And these are set up on a 3 to 5 year kind of a note. These 3 properties were all 5-year deals. And so the money is secured against the property. When someone buys it, they bring in 50% of the purchase price. So Viewpoint, again, $70,000. Someone loaned $35,000. The buyer brought in the other $35,000. And so they are motivated because they've got skin in the game to make sure that the payments are made. If they're not, then there's automatically a deed in lieu that's been signed. And if the payments are missed, all you do is file. And you file an assignment of the rents because these are rental properties. And then the next month you own the property. It's in your name. And you bought it at 50% of the price, because then you'd own Ellenwood, or Viewpoint Lane in Ellenwood, at $35,000. And then your returns on that, when you'd get the rents, actually goes up to about 30%. It's very crazy. You would not be sad if they defaulted, but they won't default because they've got half of their money in the deal. This is interest paid monthly, and it's secured on a great piece of property that's already got a tenant in place. And so that is a great asset class we really like, paying about 6%. Here's another kind of trust deeds called hard money. Now, these three pictures, the first one that came up is a bed and breakfast. This is a kind of property that's hard for an owner to finance because they live there, but it's also a business, and so they don't really know if they get normal. You're not going to get normal mortgage financing, and it's hard to get commercial financing. So these are the kinds of properties that get financed on hard money. Or the house below it. Maybe someone was trying to build a house and they ran out of money on their construction loan, and there's a property just waiting to be finished. And so hard money would come in, loan them short-term money long enough to get the home finished, and then financed out on a normal, traditional mortgage loan. Or the one to the right there is a subdivision. This is the money that goes in to secure the property, to put in to stub it, which means they put in the sewer, the water lines, they put the curb in the gutter, and then it's ready for someone to come in and build a home on. These are the kinds of properties that are secured with hard money. The returns go up on these. These are 7 to 9%, but they're still secured by real estate. And you can choose when you get paid out on these things. And if they have to pay you out less often, then they can pay you, a higher return because they can use the money longer. So if it's a quarterly payment, it would be 7% in the range. If it was an annual payment, it would be 8%. If you could let them have it for 3 years, they would give you 9%. So, again, private lending. It's a nice, solid place secured with real estate offering higher returns. And our fourth of our core 4 asset classes is what we call structured settlements or pension factoring. Let me talk just a little bit about this. This is lottery winners or people with insurance settlements or lawsuits are generally paid out monthly. And so if you're in a car wreck and the attorneys go and they sue an insurance company, your settlement is generally paid out in a monthly settlement. It's paid out as what's called an annuity. Or sometimes we've got people who have retired maybe from a great big company or from the U.S. military, and they've got a challenge that they need to solve today that requires a lump sum. Maybe they're settling out their divorce, and they would be willing to trade their monthly stream of income for a pile of money today. And so these are the kind of payors that are paying out. The California lottery. Lottery winners are also paid out on a monthly kind of an annuity. And so what we care about in this kind of an investment is our yields are going to be in the 5 to 8% range. But what we're really interested in is the strength of the payor. These are, again, paid out monthly or annually, sometimes quarterly. Sometimes the payments can start now. Sometimes they start out down the road in the future. If they're paid out in the future, we get a higher return. But what we're looking at is the strength of the payor. Here's a graphic from New York Life, one of the great big life insurance companies that issues these kind of annuities. 4 different ratings companies, exceptionally strong, excellent, very strong, or superior. But we care about the strength of the person who's paying us our money. And as we look back at that screen, these are massive insurance companies or the U.S. military or a great big state lottery. And so this is what we care about, that is who's going to be paying us out. And so again, that's a nice place, a nice way to diversify and put our eggs in another basket and still get a really solid, stable rate of return. And so we don't want to have all of our eggs in one basket, and that's why we've got these 4 different baskets or 5 where we want to put our clients' money. And the risk tolerance model that we use helps us to suggest kind of an allocation or the balance of the baskets that might be suitable. Typically, as you've seen account diversification, maybe if you signed up for a 401k or an IRA and you sit down with somebody, they say, oh, based on your age, you want to put a certain amount of money in the stocks, in a stock mutual fund, some of it in a bond fund, and some of it in a cash or money market account. But again, it's been all on Wall Street. And as we want to get money off Wall Street, we want to consider these other non-market type of assets. And you can see that gambler placing his bets, because that's kind of what it is when you're diversifying, is trying to place your bets on what's going to be better. Well, we believe that to truly be diversified, you need to be able to include some of these other alternative assets. And of course, it's what America's asking for right now. But offsetting inflation is best done with gold and with real estate. And we also want to create those monthly dividends, that golden goose kind of an asset that's going to stick money in our mailbox every month. And so real estate, with people paying us rent, mortgage trustees with people paying us mortgage payments on our money that's secured on great properties. And then these pension factoring, again, these are things that create that monthly dividend that create the quality of life. And so here's kind of our 4 basket allocations based on the questions that we ask each client. And the questions are like, how long do you have till you need your money? When will you start to retire? How do you feel about losing, maybe 10% of your account for the opportunity to gain 20% on it? And so it asks you these questions. And then the score just correlates out to one of these 4 basket allocations. And each basket allocation has a suggested percentage that we should put in our core 4 real estate asset classes. The client then gets to choose how much they want to put where. And then we help them, after they've chosen where it wants to go, then we help them find those great baskets and help them with the asset classes. Well, as again I mentioned, dividends are the key to creating lifestyle. This is mailbox money. These are passive income streams from the monthly rent, from the monthly mortgage payments, and the pension payments. Well, Dan, I hope you're there. I wanted to hand this over to you to talk about why we want to get involved with the self-directed IRA and unlock these qualified plan monies. Are you ready to take over?
I'm ready to take over. Thank you very much. Well, we've been doing this for 12 years now. We've been providing the mechanism to allow you to unlock these assets that are in your IRA so you can do all of the wonderful things that Gary was talking about. And that's pretty exciting when you get back to dividends, back to inflation protection, back to hard assets. And what makes our product available or functional for this is that it provides an investment control. That means you provide, or you're the one who's in control of the investments at all times. It opens up countless investment opportunities. Now, if you want to go back to the stock market, you can still do that with the cash flows that's come out, or maybe the sale of one of the assets. But it allows you to swing back and forth between the stock market and in hard assets, or just stay in there. It gives you access to the funds. You're going to have a checking account. That checking account of your retirement dollars is going to allow you to be able to purchase those retirement assets. Now, there are 2 ways of being able to do this. One is to use a custodian. The custodian, like Charles Schwab or maybe some of the other non-traditional guys, they give you, they hold the money for you, and they keep the money, they keep the title, they manage those funds for you. And you have to play the game that you did as a kid. Mother, I'd like to go buy this real estate. May I do that? Yeah, stay in line. There's 10,000 people in front of you. But you don't want that. You want to be able to do that today. If that opportunity's there, you got to pounce on it. They send you the money. And then there's added investment restrictions. All of these vendors have their own policies. Well, there are no policies with us. It's whatever the IRS code allows you to do, you're allowed to do. There are no delayed access to your funds, as I mentioned before. That maybe you want to buy that duplex down the street. Well, that duplex down the street, if it's in a good deal, it's not going to last very long. So you need access to those funds as soon as you can possibly get them. There's no transaction fees. There's no asset fees. And the annual fee is very small. It's about $150 a year. Now, we do have some fees to keep you compliant, to help you so you won't lose all your money with the IRS. We'll talk about those later. But those are all very, very reasonable costs and less than what you're going to be paying now. Go ahead, Gary. What does that mean? That means you have checkbook control. That means you have access to those funds, which means, in turn, because you're managing it, you don't have those annual fees that are predominantly added on there, plus the opportunity for the custodian to have those control of those funds. So you can make a deal as fast as you can write that check, and you can make that deal, as I mentioned before, with anything that the IRS allows. And it's a lot easier to talk about what the IRS does allow. And what is that? That means you can't buy life insurance on yourself, you can't buy consumables, and you can't buy artwork that you can hang on your wall. Other than that, you can buy just about any type of investment that's out there. So, to be able to help you jailbreak your IRA, these are the structures you need to get to that next step. And we're there with you to help you. We're there to guide you. We're there to make sure that you're going to be compliant. Well, thank you. I really appreciate you on this. Oh, there's one more.
Dan, you're a modest man, and I know I probably should do the screen to brag about you. There's a reason that you are our only exclusive, supplier of self-directed programs. And the reason is Asset Exchange Strategies, as you mentioned, has been around for over 12 years. Dan is the undisputed industry knowledge leader. I don't know anyone else that's been quoted in Business Week, in Kiplinger's Personal Finance, in Forbes, and the Wall Street Journal. Dan's the guy that these guys call to get information. In fact, he's done more than 3,500 clients. It's probably past 4,000 at this point. But Dan has helped a large number of people. And the interesting thing about it, if you work with the public, Dan's helped 4,000 people, and yet he's never had a Better Business Bureau complaint. A+ with the BBB, and that is amazing. They do a great job of taking care of the clients, but the thing that staggered me was Dan's company, Asset Exchange Strategies, has moved over $2 billion away from the Wall Street casinos onto Main Street type of investments, and that is, to me, staggering. That's very telling about his experience and what he's done. In fact, Dan's structures have already passed through the fire of 50 different tax audits, haven't had any problems to this point. And so we know that we're working with the supplier, very solid in these structures. He is the right person. And, he is a modest guy. Dan, I want to tell you thanks for coming and covering just a little bit about the structures, because this is what's really doing the releasing is the self-directed IRA programs. And so thank you so much for covering that. And, man, we're just glad to be partnered up with you as our exclusive supplier.
Well, thank you, Gary, and I appreciate you did that slide. It's always better if somebody else does that.
And you know what, I didn't even brag on you for your numerous industry awards. And it's interesting, you just got announced from the Best of Austin 4 years running. Dan's located in Austin, Texas, and there's a very prominent local magazine there that's named him Best of Austin 4 years running, 3 years running on 5-star wealth managers, at top financial advisors. Dan, man, he's just great. The media brags on him, the people brag on him, and we're just glad to have you. Family office, people like Mitt Romney have access to the best financial advisors. Practitioners that will give him the counsel that he needs. And they keep these guys on retainer so they can get access to him anytime, but it requires a lot of money to do that. These are the best attorneys money can buy, the best tax accountants and estate planners and tax planners. And we want our people to have access to the right kind of advisors, but we don't want them to have to pay that kind of a commitment annually to keep these guys on retainer. And so we have a small monthly commitment for the kind of people that want access to the family office of advisors to make sure they get the right kind of estate planning and tax planning and